Hello guys, it's Emoji Pips here again. We are back on our recap, our daily recap and weekly recap. So this is for the weekly recap, So please, my friends out there who haven't subscribed yet to my channel, please kindly do that. Please kindly do that, because I will be releasing much better content like this. Okay, I'll be giving daily recap and weekly recaps, and also giving daily profitable trades. Okay, we're giving profitable setups and then releasing profitable signals. I'll also be trading live as well. Okay, so Friday market ends like this, around $2,443.72, $2,243.72. So that is where price closed at. And then price started on Friday, Monday started, Sunday 10 p.m. price opened Ghana time, and then rise all the way here and then fell, right? So we want to know why the market moved this way, and what and where can we get advantage. I mean, where we should have taken advantage of. Okay, so you can see a whole lot of things on the chart. Okay, so I want to dive in to explain to you guys how I took these trades, and then the kind of concepts I employed in taking this trade. Okay, alright guys, so like I was saying, market closed last week, last week around this place. Okay, so all this is a future. Okay, we don't know all this. We don't know what's going to happen on the chart. We don't know how the chart is going to behave. So some of us that think that market is random, please, it is not random. Market follows certain principles. Okay, so market is never random. So it closed last week around this place, and we don't know all these ones. So we want to know what is going to happen and this is what happened, and then we want to explain why market moved this way. Okay, so let's dive into it. Now, first of all, the chart looks like this. So you have to zoom out. Now you have to zoom out. So first thing first, identify your supply and demand zone. So a supply zone is where we have what? A bearish, a massive sell. Supply zone is where we have massive falling with the market price, where price fell massively. Okay, a supply zone is where we have price falling massively. So this is where it began from. Okay, market was right. You can see clear. Market started rising from all the way here. Okay, it started rising from all the way here, and then when it got here, what happened? Market started falling. So where market started falling, that is where we'll have our supply zone. So we take the other block there, we highlight the other block there, so which is the last bullish candle before this massive move. That becomes our other block. Okay, so this is our other block. So like I'm saying, a supply zone where we have what? Price falling massively from. So this is our supply. We call it supply. This is our supply, right? Good. Now, what is a demand zone? A demand zone is where we have price rising from. Okay, so price started rising all the way from here. So first of all, we need to use the other block there, which is the last bearish candle before this massive move. So we'll highlight the other block there, and then we use it. Okay, so this will be our demand zone. What is a demand zone? A demand zone is where price started rising massively and aggressively. So price started rising aggressively from this point. Okay, so we expect that big institutions and people like you and I, traders like you and I, and institution will place their orders here, so that when price get back to this zone, it will start buying again. So some of us, we don't really know how to highlight this point. So a supply zone is a zone where market started what, falling drastically. It started falling what, aggressively, and then a demand zone is where market started rising aggressively. So we've been able to what, highlight our point. Okay, once we've been able to highlight our point, so this is our demand. Okay, we've been able to highlight our point. Okay, now the next thing is what? The next thing is that we do our trend line. So we draw a trend line. We draw a trend line. So this is our resistance. These are resistance. Okay, these are resistance. Yeah, that's our resistance. Yeah, these are like I said earlier, price closed around this place, so we don't know all these. So we're only doing a recap of what happened, okay, and how we could have traded it, and some of the trades that you took that it went wrong and they were bad trades, why they were bad trades. So we are only having a recap here. So I will dive into really explaining a lot of stuff. So this is what we have. We have our resistance here. So price closed here. Now price touched the demand and started rising. Okay, and it touched the trend line. So once it touched the demand or the trend line, you give it a short. So this is a resistance. So it touched the resistance, you give it a short to sell. Okay, it touches again, you sell, but then broke the trend line, got broken, and then what happened? It retested it and it started rising up again. Okay, so from here we have seen that once price has broken this trend line, has retested it and it started rising, price is now bullish. So we need to get our trend line for bullish. So when you look at this, we have two higher highs. So we join the higher highs. Okay, sometimes people use the body, sometimes it's the wick. It all depends on how you see the market. Okay, just make sure you get your supply and demand zones, and then later you get what, your support and resistance zone. So this is our support. Okay, this is our support. Good. So when we are done with this, that is it. So we don't know all these, we don't know what is going to happen, we don't know all these, but we know 1, 2, yeah, we know 1, 2 and 3, but we don't know all these. So market opened successfully, and like I said, when price touch any of these zones, what do? We give it a short. So price retested the trend line, and then what do? We buy from here. It went all the way upside. So let's dive into it. So this is where the chart began. So we're only having a recap here. So some of the keywords I also make mention of is the order block and the fair value gaps. So now you realize that this is a high, and we expect that when price break through this high, it should continue. Price should continue to the upside, right? So we expect that when a high is broken, because the market is now bullish, so in our heads, behind our mind, I mean, we understand that price is supposed to be bullish. Okay, so anytime price touch this support, what do? We buy. Okay, so now price is bullish. Yes, it's bullish, but before we take buy trades, price need to seek liquidity. Like I said, we have a big buy side which is bullish. So before we take a buy trade, price need to seek liquidity. So we have to wait for it to seek liquidity. It can seek liquidity, one, by touching the trend line. Okay, so the other way it can also seek liquidity is grabbing the liquidity itself. Okay, like I said, liquidity. So what is liquidity? Liquidity is buying and selling in the market. Okay, market is always liquidity. Okay, liquidity running through everywhere. So liquidity basically means buying and selling. So to bring it down, before you sell, there should be somebody willing to what? Buy. And before you buy, there should be somebody willing to sell. Okay, it means that if you don't have anybody selling, you can't buy, and if you don't have anybody buying, you can't sell. That's liquidity. So price would have to seek liquidity before it does something. So if you want to buy, you have to seek the liquidity. It means you are seeking sellers to come into the market. So when sellers come into the market, then you buy. So if you are seeking liquidity to sell, it means you have to seek what? Buyers. And when buyers come into the market, then you what? You sell to them. Okay? So I've explained when price touch the trend line, it has already seek liquidity to buy. So you what? You buy from there. Now you realize that price is supposed to break through this and it's supposed to displace. By doing displace, it rebroke it back downside. So what does it mean? This is what we call, it is not break of structure, because if it is break of structure, it has to displace through, maybe with a fair value gap, or it has to continue upside, just like something like here. It has to continue upside, but then nothing like that happened here. Okay, what do we see here? Price broke and then rebroke it up. It then broke it again downside. Okay, so what is happening? It means that this place is not break of structure. So what then it is? It is what we call liquidity graph. Okay, so this is what we call the liquidity graph. Now the same thing happened here. Liquidity graph, the same thing happened here. Watch carefully. The same thing happened here. Okay, around this place we have a high. Market grab the liquidity. So this is also a high, right? Now market came all the way down, broke the high, and then what happened? It came back down, rebroke it, the same high. So it means that it is not break of structure. If it is break of structure, it should have continued. So this is what we call liquidity grab. Okay, the same thing happened here. I'm cloning more. The same thing happened here. Watch it carefully. Watch it carefully. Okay, the same thing happened here. Okay, now the same thing, liquidity grab, liquidity grab was here. So all this thing price is doing is just to seek liquidity, either to buy or to sell. Okay, and then boom, you see the market touched on Friday. The market touched this what? The supply, and what do you see? It started falling, and then so at the same time, so guys, just like I was saying, at the same time liquidity was grabbed over here. Okay, so market will grab liquidity and it will seek liquidity. Simple as that. So when it touches the trend line in a bullish market, when it touches the trend line, seeking liquidity to buy. Now it grabs the liquidity to fall. So now you realize that there's this concept: market internal range liquidity, external range liquidity. Market will always move from internal range liquidity to an external range liquidity. Internal range liquidity refers to fair value gaps and order blocks. Now external range liquidity are highs and lows, being it higher highs, higher lows, and lower highs. Okay, now it means that before market will touch your trend line, okay, before market price will touch your trend line, there should be an internal range liquidity. Okay, so this is what happened. We have a trend line here. This is what we call the minor trend line. You see, after you draw your other trend lines, this is what we call the minor trend lines. Okay, this is our support. This minor trend line, this is our support. Now you realize that price touch the trend line here, gave it a touch. It gave the trend line a touch. At the same time, you have an order block here. Okay, this is what I'm talking about, the internal range liquidity. So this is an internal range. Right from there, where is it going? External range. Right from there, it's moving to an external range. So it has to come and break this. You understand? So this is the external range and this is internal range. Now, when you watch carefully, price came all the way and gave the support a touch here, right? These are history. We don't know this. We are trading from here, okay? Now, it gave it a touch. So what do? We buy. But at the same point, we want to know if it is an internal range liquidity. Yes, it is an internal range liquidity. That is where you can see what? Fair value gaps. So we can see fair value gaps. Fair value gaps. And then these are OB order blocks. Okay? I make videos explaining what order blocks are and what fair value gaps are and how to actually figure it out in a market. It means that you realize that we had one fair value gap, two fair value gaps, and three fair value gaps. Now, the market, why is it that the market didn't return from the first and the second fair value gaps? It means that these fair value gaps are not close to the support. So when you realize that the fair value gaps are not close to the support, you don't even take a shot. You see, this is a fake buy. This is a fake buy. If you could have taken this buy, you would have lost a lot because it is not close to the support. A fair value gap or other block should be close to the support so that when price touches the support, at the same time it has entered the fair value gap zone or the other block zone, and that is where we take a shot. You understand? So I took a buy here. After taking a buy here, took a buy here, took a buy here. Okay, now you realize that this is another block, the last black candle before this massive movement upside. This is another block. Okay, let me wipe this in away. So let me clone this. So this is another block, right? Yes, the last black candle. So we are following, being it small, is big or is small. It is the last black candle. Now price will come and touch. Price will actually give us a touch on the support, but at that same zone you realize that there is another block. So this is what is happening when price enters another block zone or a fair value gap zone. Together we call them internal range liquidity zones. When price enters these zones, you have to wait. You have to figure it out if these zones are close to the support. If they are on the support or within the support or very close to the support, it means it is a valid trade. So you can take that trade. So look at it. Right after touching, it started rising up. Okay. Now, at the same time, you realize that there is another what? There's another. Look at here. There is another other block here. Okay. The last black candle before this massive move. There's another other block. Now, price will come and touch the what? The support. But right after price giving us a touch, what happens? There was an order block there. So you see the confirmation, an order block that is not, or that is far away, I mean far away from the support, is not valid. Another block that is a fair value gap that is far away from the support is not valid. Something like here. Not valid, not valid. This is valid. Okay. Now, there is another block here. Market price came to the other block. So this is how you can do to figure out your other blocks and fair value gap trading by adding what support and resistance to it. So market is supposed to touch the support. Your focus is on the support. When it touches the support, you check whether there is what a fair value gap or what another block there. Okay, so there was another block here. The market came to the zone, gave a support the touch, gave the support a touch, and then started rising again. Okay, now look at this. There is another block that has been inverted here. Let me clone this thing. Let me clone this one. Okay, this other block has been inverted. A market started falling, right? Now, like I said, this is not valid order block. Why? Because it is far away from the support. So you cannot buy here. Okay? You have to pay attention to the support. Your support must be touched. So when price touches the support, you buy. You see, there is a gap. There is another block here, but market didn't respect it and broke through. So let's see why the market didn't respect this other block and it broke through. And let's see. So first of all, we've talked about seeking of liquidity, where market touch the trend line seek liquidity to what? To buy. Seek liquidity to what? To buy. So this seeks liquidity and it sells. Seek liquidity, sells. Seek liquidity, sell. So that is what is happening actually. So anytime price touch your trend lines, you what? You buy. But then internal range liquidity zones like fair value gaps and other blocks must be close to their support or resistance before you give it a shot. Okay, for bullish market, it must be close to the support. For bearish market, it must be close to the what? Resistance. So basically that's what we are talking about. Now, this is liquidity graph. Liquidity graph, we talk about it, liquidity graph. So market will seek liquidity and it will grab liquidity. It will seek from here and it will grab it. Seek and grab it. Okay, that's what market is doing. It will seek liquidity, it will grab liquidity. So after seeking liquidity, you have to look up for what? Grabbing liquidity. So a liquidity grab is when a high or a low has been swept. So look at this. It swept the high and then returned. So this is where we took a short, a stop loss here, and then it's a clear buy, a clear sell, sorry. Now the market gave that support a touch. That is seeking liquidity to what? That is going to seek liquidity to sell. So from here it's going to seek liquidity to sell. So it gave a support a touch. At the same time, that is internal range. So at that same time, there was a fair value gap confirming your what? Your position. So you can buy from here because there was a fair value gap at a zone, and then at the same time there was what? There was a trend line. Okay, so you can buy at that zone, right? Perfect. Now market started rising. External range liquidity swept the high here, and then it started falling. So you can take a sell, So what did we do? We took a buy, sell. Now this is liquidity graph, sell, and then finally when price touched the what? The zone, the supply zone, definitely you're going to sell. So you sell from here. So basically, you see, and price also after falling, it fell up to about 650 pips. Okay, so basically after price falling, you realize that we have our main trend line here, touch, and price gave it a touch, and then what do? We buy. We realize that at that same point, what can you see there? At that same point, what can you see there? A gap. This is a fair value gap. At that same zone, there was a fair value gap. So fair value gap, you don't trade them alone. You don't use them individually. You have to add support and resistance trend lines to it to make it more valid, because some of the fair value gaps and other blocks are not valid. They are not valid means that they are not close to the support or the resistance. When that happens, it will be disrespected. But when these zones, this fair value gap and other blocks are close to what? The support or the resistance, just like here, it is close to the support, it will be respected. You understand? So that is why I took the buy, and we are still in the trade. So last week was a winning trade. We took a buy, 1, count it, 2, 3. We took a sell because it swept the liquidity. So the liquidity grab happened, swept the liquidity, so grab the liquidity, so we'll fall with it. It seek liquidity to sell. It's going to seek liquidity to sell, and it grabbed the liquidity, and then we fell. Okay, so basically that's what price is doing. It moved from here. It's after giving the support a touch, it is going to seek liquidity to fall. So it goes. Now this is a high, grab the liquidity, and then started falling. Then once it is falling, what is it going to do? It's going to look for what? Seek liquidity. It's going to seek liquidity to rise. So it is coming to seek liquidity. It gave it a touch. At that same point, there's a fair value gap or there's another block. Gave it a touch, and then it started rising. Okay, market started rising, and then when it's rising, what is it going to do? It's going to grab the liquidity because it is going to seek liquidity to fall. Okay, so it's going to grab the liquidity. This is going to grab liquidity. So grab the liquidity up here, and it's coming to seek liquidity to rise. Seek the liquidity is going to grab the liquidity. Grab the liquidity, you see, down, and then seek the liquidity, So it grabbed the liquidity here after touching the supply, and then market price fell. So market does what? Two things: grab liquidity and seek liquidity. It moved from internal range liquidity and to external range liquidity. Internal range liquidity refers to fair value gaps and other blocks. External range liquidity refers to highs and lows. Markets will always respect fair value gaps and other blocks when they are close to support and resistance zones. Anytime market get to the supply zone, it will fall. And anytime market get to the demand zone, it will rise. Demand zone is where price started rising aggressively, and then supply zone is where we have price falling aggressively. Now, for us to take a give a shot in an internal range liquidity, market must give what? Our support or resistance a touch. Now, for us to trade a liquidity grab, a high or a low must be swept before we can take that position. So basically, that is how our trade went. So it was like this. So this, just look at it. Look at this. This is the next supply. It was like this. Then we drew an inner minor trend line, and then it gave us a touch. Winning trades, give it a touch. Okay, so you have to be mindful of support and resistance, because your skills will not always help you out. Sometimes your skills can fail you. You understand? Your skills can fail you sometimes. You know, trading is like learning to ride a motorbike. So when you learn to ride a motorbike, you need to put on your helmet, because your skills can fail you sometimes, which can put you into a very serious situation. Okay, a very serious accident. So you always need to have your helmet on. If you learn how to drive, you still need to fix your belt. That is how trading is. Even if you are a very good trader, you need to understand that market does what it wants. It does what it wants. So it doesn't care about you. So you just have to keep yourself from losing more. So you save, you win bigger and you lose less. That is how. So you have to be mindful of supporting your risk management. Okay. Even if you are very good, you are a very good trader, and you don't know how to manage your risk, you will still not be profitable. A profitable trader is a trader who loses and gains, but at the end of the day, his wins are more than the losses. That is the meaning. You can win 3 and lose 5, but because of your risk management, your wins amount are, far higher than what? Way higher than what? The loss amount. So these were the buys. Okay, and then I took a buy too. Okay, here. Yes, but we had a loss. It was a loss. It was a loss. So just like I said, it won't favor you all the time. It won't favor you all the time. Now let's look at the sell side. The sell side that we took, the sell trades. So we have a clean trade right now. Now we took a trade from here. This is a liquidity grab. You have to understand this. Liquidity grab. Grab the liquidity. So we put it where? At the support, where it is coming to seek the liquidity. Okay, so liquidity grab happening here again. It happened here too. Here, right? So this is the point we close it, and that is where we will buy. Okay. So this was the buy side for last week. Last week this was the buy side. Okay, this was the buy side. We took profit here. Okay, we closed it here at the next supply zone. We moved from the demand to the supply. So these were the trade for this week. Yeah, this week, not last week. Sorry, this week. Now let me clean it and do we took certain sell trades. Okay, so this was the loss that we made in a buy trade when market didn't respect the trend line, but yet there was another block there, but I didn't respect it. We broke through it. Okay, so this was the sell, the loss. So the loss was just around 47 pips, and we've already won about around 1,500 what profit. Okay, we are far away from what loss. So that's what we say profitable. Okay, now let's look at the sell side. The sell side, there was liquidity grab. there was a liquidity grab here, so we took this sell. Where do we close it? At where is the support? So we say market is bullish because there is more buying side than what selling side. So you see that the sell is very small. We are taking profit around 216 pips against 60 pips. Okay, now we took another sell. So here we are looking at only the sell side. We took another sell. Liquidity grabbed. Liquidity was grabbed here. Okay, you have to set your stop loss not too tight, but it should be not too far away from price. Okay, yeah. So there was a liquidity grab here, and at that same time there was a liquidity grab here. So at that same time, what do you see? Market has approached what? The supply. And you see, this where we want to take our profit. This is where we want to take our profit. And at that same time, we also took another trade because we believe that market will definitely. So this is where we took our trade. In the middle, we normally put it in the middle, 50% of the zone, and we'll put it above, not too tight, because sometimes it can break through before it continues the direction. So this is where we took the trade, and this is where we closed it. And then when price hits the support, we buy again. Okay, when price hits the support, we buy again. And this is where this trade we haven't closed it yet. It's still in the market. Okay, so basically this is what we have. If you want to see what I was talking about, let me come here. So in this trade, you realize that we are still in the market. You understand? We've not closed it yet. So basically, that is what we have learned in our recap. So next time when we are taking trade, we should take very good trades. On Sunday, I'll release speculations where I think price can go. So right now, price is coming all the way to touch this trend line and fall. If it breaks through this trend line, it will come to the supply and then fall or break through and test. So we want to wait till next week, then we know what we will do. Okay, thank you so much for your listening ears, and if you have not subscribed to my channel, kindly do that for me, kindly for you too as well, because we'll be releasing better content than this. Speculations, daily trades, daily signals, recap on a daily basis, and recaps on what? Weekly basis. So basically this week has been profitable and we are still happy about it. Thank you so much, and God bless you, and stay safe, and then don't give up, keep going, you will get there. Bye. Emoji clips once more.